Okay. For those who missed the market update seminar, this is actually the more important seminar. For those who missed the market update seminar, that's going to be on the website. I'll show you after this presentation's over where you can find all the presentations if you want to for that. And that was a lot of information. I think we went through, I think, over 100 slides in like 45 minutes. And it was a lot to gather. But the bottom line is that this seminar is the one you really have to pay attention in, because this is the one that really is the most important one. So if everybody can let me just make sure I'm muting everybody here. So we're ready to rock and roll. If anybody has any questions, just unmute yourself. Okay, so I think everybody's muted here. So everybody's muted, and now we're going to get started and talk about what we need to look at over here. So, so, and this is actually this is the same presentation I've done a few other times, but I've added a few more slides to it because I think it's really important. Because one of the concerns that people have is, you're investing at essentially was an all-time high right now. Is that a concern? And this chart kind of shows you it really isn't. It shows you that the market, has had like a 15 all-time highs already this year, and the market does generally okay. Obviously it's better to not invest in an all-time high, but generally you can do fine by investing in the market at an all-time high. And it kind of shows you looking forward. Another slide shows you it basically looks like you could still do okay investing at an all-time high. This slide over here is one that for those you wanted to look at one slide. This slide I think is really informative, and it's really a mouthful. It kind of shows you, despite average inter-year drops of 14.1%, annual returns were positive in 34 of 45 years. And what that means is that even though the market might start out being down in the beginning of the year, most of the times it actually works out to be higher. So it shows you this year, at one point, the market was down 19%, and at this point it was up 6. Last year it was down 10%, but ended up. So it just shows you the market is very scary on a short-term basis, but even on a one-year basis, it really is not all that scary. And generally, what's interesting here is the market does go up. The market goes up more actually when the market goes down for that. Now this I thought was really interesting because I've just recently, I'm actually on this chart. I was born in 1960, and it shows you this a little dated. This the age that I'd be now. This is actually a couple of years old, but it shows you how many bear markets I've experienced in my life. That's about 14 of them, and it shows you, what the market, how long it's lasted for, and it basically shows you that markets are a normal down markets are a normal occurrence, and not to freak out about them too much. And this basically shows you that over a long.
Write it out.
Let me see. There's somebody who's. I gotta mute. Okay, so I'm going to mute you, Christine. Hold on. Okay, so this is basically showing you that markets have rewarded discipline, even though the market has gone down during all these horrible periods of time. That generally the market marches right up. It shows you what you would have at that point in time. This is showing equity scenarios, the bulls and bears, how long they take to reach a high from there. We're not too concerned about now because we haven't had a down market, but when you do have a down market, this is something to look at. That the market generally does, take maybe a little bit of time to go up from there, but generally you do reach an all-time high from there. And this is, I thought it was a cute chart with little bears and big bears in here then too, but it shows you that generally, 74% of the time, the market does go up. And that's where I told you, if you would go to Las Vegas and you found a slot machine that generally goes up 74%, you win 74% of the time, that would actually be pretty good. Now this is showing you negative years and positive years and all the different, how the returns have been over a period of time. And basically this shows you that over a long period of time, you do well in the stock market. So I just had a discussion with somebody who was telling me about What if the market goes down? And the truth is that the market can go down, over a short period of time, but as long as you have enough money to do what you need to do, you should be fine. And this kind of shows you, after the worst days in the market of all these period of times, what you would have made in the days after that. Because that invariably is when you get the best returns, is when the market is down and everybody's really scary. That's when you can make the most amount of money. Now, this is really the second most important chart, and I think it really tells a lot. And if I had to just pick one chart to look at, this would probably be it. This would be the one that shows you that the market in equities, since 1950, over the 74-year period of time, you've made a range of 37% down to 52% up. Now, if you were in a diversified portfolio, it'd be 33 to 13, kind of scary over 1 year period of time. But what's interesting to really look at is that over a longer period of time, you actually would have made positive returns going out 20-year periods of time in the market. So that actually shows you that, again, over a short period of time, the market is very scary, but over a long period of time, really not so much. And it kind of, again, this shows you, the probability of having negative returns going out like 10 years is really pretty low. Now, this is also another thing to look at, is that when you look at being in the market, performance of $10,000 invested, and it shows you if you fully invested, you would have made 10.4% over this period of time. But if you would have missed the 10 best days in the market, you would have lost about 40% of the performance of that. And you would have missed the 20 best days, you would have missed about 70% of the performance. So again, it's important to be in the market even when the market isn't doing so well. And this also shows you that by the time you have, basically getting out of the market, the average rate of return following a daily drop of 4.8 was about 23%. So it kind of shows you that when the market's down is actually the time to get into the market. Now, this is also, I think, a telling slide. This slide shows you that, the market has had some really great returns over this period of time, but it shows you what the average investor had made over that period of time compared to what the market's done, and it shows you what inflation has done over here. So it's important to really kind of be in the market and to kind of be in the market really at all points in time. This shows you why the people in the market don't do generally as well as the overall market. It shows you, like, when the market's down, they buy more bonds, and when the market's up, they buy more stocks. So most people, what they do is they buy high, they sell low, and repeat until broke. So that's the thing you want to avoid. You want to kind of come up with a risk tolerance that you're comfortable with, and then kind of stick with it. Now, when you look at this chart, everybody talks about the market and the price earnings ratios. And this I thought was kind of interesting. It shows you that generally, what is a stock market? It's a bunch of companies earning money. So when you look at this, it shows there's a really strong correlation over time between what companies are making, what they're earning, and what the stock market's doing. I kept this slide in here because it shows you during the epidemics that we've had. Generally, it shows you that even in an epidemic type thing, that the market generally does well shortly thereafter. And this is really the roller coaster that people are generally on over here. It shows you that people are optimistic, elated, nervous, fear, and optimism. And basically what you want to do is kind of get the roller coaster out of the market and just kind of stick with it. And that, again, this is a slide that shows you, excuse me one sec. This is a slide that generally shows you that the stock market generally does fine over time. And that, it actually shows you that over a longer period of time, that small caps have done better than large caps, but not recently for that. This is a slide that shows you how the market responds to crisis, and basically shows you that, 1 year, 3 years, and 5 years later, even with all these horrible things that have happened, that generally the market does just fine. This is kind of showing you about, many people think they have a crystal ball and they act like they do, but it doesn't really work that way. It basically shows you to, again, stay in the market over a period of time, even, and not to avoid the worst days in the market with that. And some people try to find some patterns in the market, but generally that doesn't work. Basically makes sense just to stick with the market. This is another slide that shows the same thing. And again, these will all be uh, available for people to view at their leisure. But the general gist of this is when you look at this, the market generally has been up much more than it's been down. Even with these horrible things that have happened, you look, there's a whole lot more of this aqua blue in here than there is of red. It's another way of looking at the same chart that, again, 74% of the time the market is up. I have to get this slide updated, but I think for those who like to go to casinos, and I know my brother's on the call, so this kind of shows you that there's a much better chance of being in the stock market and making money than there is by playing blackjack or roulette or some of these other games over here. Um, so this is a slide that shows you even with bond returns. Generally, bonds don't really have negative years. Um, but we have had some negative years actually in 2022. But even still, it's the same as the other things. Is that you don't want to react to short-term performance in those things. And this basically shows you want to stay diversified, not just have the presentation we'll be talking about tomorrow is why you want to diversify from the Magnificent Seven. It's really hard to like pick, top stocks, just stick with them over a period of time. It makes more sense to just try to be in the market and get most of the market return. Now, this is a slide where I usually tell people to pick a number for between 1 and 10, double that number, uh, uh, divide it by 2, and then subtract the original number. I think if I did that right, you should end up with then you pick a number that you came up with, and you actually pick a letter in the alphabet. The bottom line is you're going to come up with going through that slide, that thing where the answer is going to be Denmark. I don't want to go through the whole thing now, but the reason I tell you that is because when you look at this, it shows you want to be diversified amongst all these different, not try to pick necessarily the best country, even though the best performing country in the world actually has been Denmark. So this is actually showing you want to have a diversified portfolio, having both U.S. and also international exposure. Now, another thing which people might want to add to their portfolio is having some of these alternative investments, because these historically, have helped to, increase the returns of portfolios and reduce risk in there. And this is another thing. This shows you that this is really what's showing you by adding these alternative investments to portfolios. It's helping you to get greater returns with lower risk. Now, with alternatives, it's kind of interesting. This is a chart that shows you that, the difference between really great managers and really poor managers in like large cap stocks isn't all that big a difference. But when you start looking at this as far as alternatives, it gets to be really quite a lot more dramatic as far as that goes. Private equity is another thing, which I think is a nice thing to have in people's portfolios. That actually, there's 6 million private companies in this country, and there's only 4,000 publicly traded companies. So basically, it kind of shows you want to have some access to some of these growing companies over here then too. Now, when you look at this, REITs is another thing people want to look into, and this shows you that the institutions are there, the Harvards of the world and the FPLs of the world, they're investing in differently. They have a lot more of their money in these, private equity and hedge funds and things like that. And it basically shows you that by investing in these things over a period of time, you end up with greater return and lower risk. And this is a chart which can kind of, a lot of colors on it and stuff, but the bottom line is you're trying to, have a more diversified portfolio to kind of give you a smoother ride. Now, what we're really talking about over here is really looking to see there's different ways of making sure that people are going to be okay. What you can do is you can have some stable income, stable spending type things. You might want to get some pension, Social Security, and some guaranteed income for that. Some of your other things, your variable spending, you might want to have something that's growing over there. Then if you have a legacy, you might want to have more growthy type things in there then too. A way of structuring this also is by having a so-called bucket approach to investing, where you want to have some money safe and secure for the next couple of years. I just was talking with somebody today, and I was telling them that even if the market goes down, as long as you have enough money for the next year or two to do what you need to do, then that should make you feel more comfortable for that. And basically could end up with the same result by having the asset allocation a different way, but it's easier to talk people off the ledge if they know that they have money that they haven't lost in the market. Because invariably, like I showed you earlier, the market generally does have a bounce back within a couple of years for that then. So now we're going to talk about the 5 risks of retirement. And one of the risks that we have is, longevity. What if you live to 120? This is showing you the average lifespan of people. And this is actually, for women, it's like 25% are expected to live to 95. And the thing about this, these statistics are getting longer as time goes on over here. So basically, when I do planning, I usually assume at least that people live to 90. And if they're healthy, their parents are still around, you might want to assume 95 in here then too. Um, and what's interesting here is that the wealthier you are, generally, it's like you not only get more money, you also get to live longer too. So it kind of shows you that wealthy people actually have a greater longevity than poor people. I guess it's because they can afford to go to the doctors more often and get better care for that. Now, so that's one of the risks you have is longevity risk. The other risk is something called point in time risk. What if you retire at absolutely the worst time and the market goes down at that particular point in time? And that's one of the countervailing type things is that people need to, have something that's going to grow, over a period of time if they live to 120. But if they lose the money right in the beginning, that gets to be a much worse result. And if we have time later on, I can show you the software that actually shows you like you can have the same exact portfolio for different people at different points in time. Somebody's taking money out at that point in time, somebody's putting money in, and they can have the same exact results in the market and end up in completely different places over there then too. This is kind of show you, what does it take to recover from a loss? And, it's pretty simple. If your market goes down by 50%, you need 100% to make up for that. And people don't really think about that. They think, well, the market was up 10, the market was down 10. All I have to do is make 10% to get even. You actually have to make 11.1%. So again, not losing money is actually a good thing as far as making sure you have enough money there. Now, this is showing you there's this guy who came up with this rule called the 4% rule. He came down from a mountaintop one day and after calculating, looking at 65-year-old couples and see their chance of success. And what he basically came down to and say if a safe withdrawal rate is considered to be a 4% withdrawal rate. Now, this can, the older you are, you can probably take out more for that. But this is what they look at. But the problem is that it's changed over time. Like now, the interest rate assumptions he had in there were different. And it's something that I don't think you should really just rely on a hard and fast rule like this. I think it's based upon people's own circumstances then too. So, and there's a varying opinion based upon what people are thinking as to what is actually a safe withdrawal rate. The safe withdrawal rate is that the amount of money you can take out of your portfolio and make sure you can reach your goals for that. And you want to an interesting thing that you could look into is, when the market is down, a simple thing that can actually help your chance of success with that is just the years the market's down, you just spend less at that particular point in time. This kind of shows you the long-term view of things. Now, the BetaVest presentation, I'll hold off on that for now. That's just showing you what I just talked about, and I think in pretty good terms for that then too. Now, the third risk of retirement is inflation. Now, the reason I like this chart, this little thing, this is actually normally when I'm in front of people, I have this stamp from 1975, which I think really, the value of the stamp is 10 cents, which kind of I think illustrates really well as to how much, stamps, this is the hard part of the presentation. I'm not really sure what a stamp costs now. Maybe it's 60 cents. Somebody can correct me on that, but it just shows you that something simple like a stamp has gone up 6 times as much. So basically you need to have something that's growing. Otherwise you're going to be, not staying in place. And this kind of shows you like in 1920, what a quart of milk cost and now how much, you would get for that then too. You get less tomorrow and the inflation risk you have. And the thing about it is that people are always talking about CPI, the Consumer Price Index, as being the be all. It's really not. Like elderly people actually end up having greater inflation costs because they spend more money on healthcare. And healthcare is still a large component of what people are going to be spending in retirement. So, and over a period of time, this kind of shows you the certain inflation rate. It shows you what you will actually, what $100,000 will be worth in the future. Like at a 6% inflation rate in 30 years, that'll be worth about $15,000. So it's just something to keep in mind. And this purchase power erodes over time. So it's something that you have to make sure that you're something that's growing and going up in value. Otherwise, you're going to end up, not having as good a lifestyle later on down the road. As far as spending and inflation, this kind of shows you again, it all depends upon what class you're in. If you're spending things on food and beverage, maybe not up as much. Healthcare has gone up a lot. Housing costs have, changed over time, and the different things, different cycles of your life you might be in, you might be spending in different ways for that then too. This is just a little trip down memory lane over here. Kind of shows you what the price of cars have changed from, the price of homes have gone to, and also it shows you what the cost of living for people over there. People are making more money, but it's costing a lot more. This I like to keep in the presentation, and I think for people listening for the first time, it's just something to just think about. Like the market can be really scary over a short period of time, but this I think really identifies what's really happened over here. It's showing you, over a period of time what this what you would have gotten in dividends and what you would get today. You're almost getting you guys 6 times as much as you're getting in dividends. And the S&P 500, this actually, we have to correct this. This should be from 1975 on this chart. This is showing you what you would have had. The S&P 500 has given you over this period of time with that. So this is again showing you what the inflation has gone to over here and the healthcare costs here as well. This is another risk that you have in retirement that is also important is healthcare costs. This is saying that an average healthy 65-year-old couple will need about $315,000 to pay for medical expenses, and that does not include long-term care costs, which is something to think about. So it's something to, that you want to set aside. And for those of you who are younger, that's why it makes sense to set aside money in things like health savings accounts to make sure you're covering all these costs over here then too. And this is the expenditures everybody thinks, so I have Medicare and I'll be covered, but all these other things you have like the Part B premiums, Part D, out-of-pocket costs, Medigap, all these things over here, then it's still going to cost you a lot of money in retirement for healthcare costs. And this kind of shows you the different cycles of life. Younger people probably spend more money on things like tuition for their kids and education. But as you get older, you start spending more and more money on things like healthcare. And this kind of shows you the income replacement. The wealthier you are, you get less money from things like Social Security. It's generally Social Security is a bigger contributor for people who have lower incomes over here then too. So now as far as Medicare, that's something I just signed up for myself. It's something that people have to really look into the different type of plans you have over there, whether you want to get your Medicare supplements or you want to go into a Medicare Advantage. I generally think that probably a Medicare supplement does make sense if you want to have your choice of different doctors, but that's people's own opinions they have over there. And you also want to make sure you get a Part D coverage for that then as well to cover for your your prescription drugs and things. Now, an important thing that is really that people lose sight of sometimes, but you will get a shocking letter in the mail when you see that you're going to be charged more for your Medicare supplement if you make more money. So some people can pay, whatever, like 5 times what the other people are paying as far as that goes over here then too. So it really is something when we do planning and we do have software that incorporates all this in the software and kind of see like what the sweet spot of how much they would do. And it's probably a good reason why it makes sense to maybe do your Roth conversions and things like that for people in their 50s. And I know there's some people on this call in their 50s. It makes sense to maybe do your Roth conversions like sooner rather than later, because when you get to Medicare, these surcharges could get to be, quite large if you do it in those years. So as far as long-term care goes, I know there are some people on this call who are looking into long-term care. It's something that's really important. You get it from different sources, from family and friends, from your savings, from insurance and things like that. But Medicaid is really things that people think they're going to get from there, but it's really unlikely to get it from there. And long-term care is one of those things that is actually keeps on going up in price. That's actually, so I think it's going up like 5%, the inflation rate on that. So it's actually something I like to put that in a plan to see how much that long-term care might cost. So as far as Social Security goes, this is something that is really important to look at as well. I mean, generally the gist of this is that it shows you if you wait, you get like 75. If you turn it on early, you'll get 75% of what you would normally get. And if you get it at your full retirement age, you get 100%. And if you wait till age 70, you'll get 132%. So this is actually pretty dramatic. And then on top of that, you're getting inflation on these numbers as well. I have software that helps to determine the optimal time to turn on Social Security. Generally, they do recommend waiting a little bit longer for that. But then again, the other countervailing thing is if you could take that money, if you have to take money out of your portfolio, maybe you could invest in the market and you could make a greater rate of return on that at that particular point in time. But it's important to be able to see the numbers to see what that will do for you at that particular point in time. And yeah, this is actually showing this as well, the various claiming strategies, and it can get kind of complicated as to what would happen if you're married, and what would happen with your spouse, and what would happen for survival benefits and things. But it's actually I have software that helps with those different things over there then too. So the last thing that I usually do as part of this seminar is the net unrealized appreciation and Roth conversions. These are things where I think, especially now, it's important to look at things like maybe doing Roth conversions. Now that we know the tax law is all settled, it probably makes sense to look every year to see if you can do a little bit of that, because I think that with the budget deficit as to what it is right now, I think the tax rates will be going up in the future. So I think that's something that people should consider and look into. But you want to look and see what your marginal tax brackets are as far as that goes. And net unrealized appreciation, I don't think there's anybody here, but that's something that can be used for people who have company stock in their plan. And it's a way of getting potential capital gains on what would normally be a retirement asset. So for that, and you want to look at Roths at different stages of your life there then too. Now with the new tax law that was changed, the big beautiful bill, there are some opportunities for people to have do things like with donor advised funds and things like that, where you can get a big deduction this year. There's also special deductions you get if you're over 65. You get a $6,000 additional deduction for that. And that's something that, could help to reduce people's taxes. It's not like Social Security is not taxable, but that was what was touted that was happening. But by giving you, potentially $6,000 to $12,000 of deductions, you're actually helping with pay off some of that tax you're having on Social Security then too. So, and this is basically showing you want to maximize a health savings account there. So, and this is again showing you that as far as the interest and tax rates right now, they're actually pretty low, compared to what they've been historically. This is if you have anybody young person trying to talk them into investing. That's why it really makes a lot of sense for somebody in their 20s to consistently, to put money at an early age. They end up with a whole lot of more money than people who start later. So that's an important chart for people you want to share with some of your, people in their 20s and 30s for that then too. So I don't think I want to go over the BetaVest presentation unless by popular demand people want to hear that. But basically the gist of that is it shows you over a period of time as to what that would look like. And it's actually something that I think makes sense for people to look into. So does anybody have any questions? Comments? This is the audience participation part of the presentation. Nobody?
I will say with what's going on with my mom and dad, this long-term care is really opening my eyes how we need to start planning for ourselves.
Right. Yeah, I think it is. It is like there's a 70% or 75% chance that you will need long-term care, and it gets to be, super expensive. Um, and my brother's on the line right now. We know what happened. Like, there's different types of policies out there. There's one policy. The policy I had for my parents is one where there was something called a reimbursement policy, where they're able to get reimbursed for the expenditures. But the problem with something like that is you had to go to a licensed provider, and the licensed provider might be getting, from the agency, might be paying $50 an hour, but the person doing the work might be getting $15 an hour. So, so it's one of those things where the policies that I like better are ones where you have, it's a indemnity policy, which means once you qualify, you get paid cash. So that's something that we can look into, and I can show you what that would look like. I like that, and I think, it does look like it's expensive, but in the long run, when you do a plan, it's something that there's a really strong chance that that you will need it. And I know it's generally the men die off sooner, and the women end up being the ones needing the long-term care, and the insurance companies kind of know that, so they charge a little bit more for women to have it than men. But I still think it is something that makes sense to look into. So that's something, if you want to, I can show you what that would look like. Okay. Anybody else have any questions or comments?
I'm good, Steve. Thanks.
Okay. Good seeing you all. And this will all be recorded if anybody wants to study it in greater depth. And
See you tomorrow.
see you tomorrow. Yeah, we'll see you tomorrow.
You were wonderful, Steve.
Thanks.
Thank
Okay,
you.
everybody's. Oh, we did have a
Steve.
few more people. Okay, so nice seeing everybody. Let's see who else joined me over here. I got Lisa. I got Christine. Paul was there. Okay. It's kind of like roll call. Goodbye, everybody. I'm going to trivia
Hi,
now.
Lisa.
Hi, Rick. Hi, Bruce.
I'm
Good
going to
luck.
trivia.
Trivia.
No.
Okay,
I have a question for you, Steve.
what's that?
At 63, how much does long-term care cost for me?
For you,
Isn't it
It
very
would-
expensive?
it would be fairly expensive. Plus, they're really picky. Like, you have to be in really good health, and you might, there might
I'm
be
in
some
great
issue.
health. I'm at the gym now.
You're at the gym?
Yeah.
Okay, I see.
Look at my
Yeah.
knees.
Your knees are moving. Okay, good. That's nice. This is all being recorded, Rick, so this is part of the show over here. If people want to say, they can see your knees and see what's going on. I think it's time to end this
Well,
call.
you used me as a prop already.
I can show the picture of mom and dad over there then too, so that's always a good one for that. I didn't tell the full long-term care story yet though, but
Thank God.
All right. Good night.
good night, everybody. You going to
Have fun.
trivia? She's hanging up on me. Okay, bye.